All right, let's get right into it. Today, we're taking a close look at Keppel REIT's full-year results for 2021. And let me tell you, it was a huge year for them. We're talking major portfolio reshaping acquisitions. So what's the story behind the numbers? Let's dive in.
Okay, so boom. Right out of the gate, this is the number you need to see. $11.7 billion. That's the new total value of their portfolio after all their moves in 2021. We're talking a nearly 23% jump in just 1 year. It's a massive figure, and honestly, it really sets the scene for everything we're going to talk about next.
Okay, so let's break this down. We'll start with the good stuff, because there's definitely a lot to like here. If you pop the hood and look at the engine, the core operations, the portfolio had a really strong year. So one of the first things I always look at is the net property income, or NPI. You can think of it as the raw profit their buildings are generating after paying for all the day-to-day running costs. And what do we see? A super healthy 6.9% jump from the year before. This isn't just a number on a page. This tells you that the properties they already own are working harder and bringing in more cash. That's exactly what you want to see. And here's a big reason why that NPI number looks so good. Check this out, a positive 11.5%. What does that mean? Well, it's something called the rental reversion rate. Basically, when a tenant's lease came up for renewal, Keppel REIT was able to sign them back on for, on average, 11.5% more rent. That is a fantastic sign. It screams that there's huge demand for their prime office spaces. Look, this kind of growth doesn't just happen by accident, right? It's not a fluke. It's more like a recipe with a few key ingredients. You've got fresh income coming in from a new building in Australia. You've got them filling up more desks and offices in another. You've got those higher rents we just talked about across their Singapore properties. And on top of all that, they even managed to cut their borrowing costs on some deals. It's just solid, smart management all around. Okay, so things are looking pretty rosy, right? Well, like with any big financial story, there are always a couple of sides to it. To really get the full picture, we have to look at the flip side, the trade-offs that came with their really ambitious growth plan. And this is probably the first thing that would make an investor kind of raise an eyebrow. The distributable income, now this is the pot of cash that's actually available to be paid out to shareholders, it actually went down a little bit, only about 1%, but still, down is down. And you've got to be asking, wait a minute, how did that happen when you just told me business was booming? Well, the company gives us the answer right here, and it really all boils down to one word: timing. See, to pay for these massive new buildings, they had to issue more shares, or units, as they're called. So imagine the profit is a pizza. The pizza got a little bigger, but now there are way more slices to hand out. And here's the kicker. 2 of their biggest new properties were bought in the last 2 weeks of December. So you have more shares out there, but the shiny new buildings haven't contributed a single dollar of rent yet. That cash only starts hitting the books in 2022. It's a classic timing mismatch. Okay, let's switch gears and talk about something every investor keeps a close eye on: debt. Now, before I show you the number, let's just quickly get on the same page with the term called aggregate leverage. Don't let the fancy name fool you. The best way to think about it is just like your home mortgage. It's simply the company's total debt measured against the total value of all its properties. It's a super important health metric. All right, so at year end, their leverage was, 47.9%. Whoa. Okay, for a REIT, that's getting up there. That's definitely a number that jumps off the page and makes you go, But, and this is a huge but, context is absolutely everything here. And here is that all-important context. That scary-looking number, it was just a temporary snapshot, a blip. It was caused by short-term loans they used to finalize a big deal right at the end of the year. The key thing is, those loans were completely paid off in January 2022, just a few weeks later. The real leverage, the underlying number, is actually closer to a much more comfortable 40.4%. So by the time we even got these results, this was already old news. So you see how all these numbers are connected? They're all part of a very deliberate strategy. Let's zoom out a bit and look at the why behind all these big, bold moves. And honestly, this one chart tells you almost everything you need to know about their strategy. Just look at it. Nearly 80% of their entire portfolio is right there in Singapore. This isn't just a preference, it's a massive bet. They are doubling down, going all in on their home turf, because they believe it's one of the best and safest office markets on the planet. So what were the big moves? Well, there were 2 main ones. First, they bought an even bigger piece of a crown jewel property, the Marina Bay Financial Center. That's them strengthening their core, right? But then they did something a little different. They went out and bought a big stake in a shopping mall in Sydney. This is a brand new playground for them. It's their first ever pure retail asset, and it's a clear signal that they're looking to diversify their income streams.
Okay, so that's the story of 2021. But as an investor, you're always asking, so what's next? So what does this all mean for the coming year? Let's finish up by looking at what's on the horizon, both the good and the potentially tricky.
All right, so looking ahead, here's what everyone's going to be watching. On the plus side, the biggest opportunity is pretty obvious, right? They're going to get a full year's worth of rent from those new assets, which should give their income a really nice boost. And they're banking on the Singapore office market staying hot. The challenge? Well, the flip side of that diversification is that now they have to learn how to manage a big retail mall in Australia. That's a whole different ballgame from running office towers, so making that integration smooth will be key.
So there you have it. 2021 was, without a doubt, a game-changing year for Keppel REIT. They took on some short-term pain, some messy-looking numbers, all to set up their long-term game. They've beefed up their core business, and they've placed a new, interesting bet on retail, which leaves us with a billion-dollar question. Will it all pay off in 2022? This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.